Okay, in today's episode of the Investing City podcast, super excited to have Nick Dennis from Southridge Global Capital, who runs a sub-advisory of Anchor Capital. So thanks so much for being here, Nick.
Great pleasure. Thanks for having me on. I'm a fan of the podcast.
Thanks so much. So why don't we jump in with a little bit of your background and sort of your evolution of your investing. It seems like you've had a big evolution, so let's just kind of start with that.
Yeah, so I'm from South Africa. I live in Cape Town, but grew up in the city of Johannesburg. And my dad used to run a public company called Tiger Brands. So it was really a consumer focused company, so fast moving consumer goods. And I think through him, he would show me the newspapers on a daily basis and try to explain things like PE ratio and all of this other stuff. But I think what I also inherited from him was just a love of brands and just really consumer-facing companies. That's like he's from a marketing background, and that was what he was really into. And he, I guess, sort of seeped through the ether like a sort of the focus on. He was very focused on return on invested capital, sort of margins, like all of that kind of good stuff. And then, so I studied a finance degree in South Africa, and then I did essentially what is like accounting / like auditing articles for 3 years. And in South Africa, that's almost like that's your route into business. I knew I wanted to get into business somehow, but I didn't know exactly what. And then I had a meeting with my dad. Introduced me to an asset manager, and he explained to me what asset management is, and I thought that's pretty cool. I could do that. Like I knew I didn't want to do a whole lot of other stuff, but I thought that would be really interesting because I like geography, I like economics, I like business, but I knew I didn't want to actually run a company and be an operator. So so after I finished articles, I went to I did corporate finance for about 15 months. And then I moved to the UK. My dad gave me a list of fund managers and analysts that he met over the years. So I just hit them up with an email saying, this is who I am. And I sent them a bit of research on stocks that I held. And so I managed to land a role at Pictet Asset Management in London. And that was in the emerging equities team. And so they didn't have someone covering consumer. So they said, look, you seem to have a natural sort of passionate interest for it. Have a crack. So I did, and so I was there for 6.5 years. That team was in sort of back then had like very much of a traditional value focus. So it was more like sort of low PE type stuff. That's never really been me, and particularly in the consumer and the sort of more internet type stuff. I've always had more of a focus on like quality and perhaps growth. So I think I helped sort of shape some of their sort of thinking over time, but look, that was always going to be more of a sort of a value portfolio. So after 6.5 years, really I had 3 kids there, and then I wanted to raise them in South Africa, and I wanted to start a fund, and so I partnered with a firm, Anchor Capital, and we launched a fund in March 2015. I think when I started, the portfolio had more of a traditional kind of growth at a reasonable price kind of flavor. And then some of my kind of old favorites from my Pictet days. So I had some sort of EM names from Russian retailers, which had been rock stars for ages, and some Chinese autos, which had been rock stars. They weren't rock stars for much longer than that. But I think, so I had more of a kind of, so the fund had more of a GARPy kind of flavor with some more kind of out and out growth names. I could put stuff like Facebook and Amazon in their relatively early days when they were sort of a lot more. I think this was early on in the sort of AWS kind of time, so it was a bit. Amazon was perhaps more controversial then than it is today. Same thing with Facebook, which much higher multiple 5 years ago. And then I think what I sort of learned over time is, perhaps I think my strength is finding, I guess, more unorthodox stocks and names that aren't necessarily traditional GARP growth at a reasonable price. They might look like growth at an unreasonable price, but I found some of these things that I thought were just too expensive would go up 10x, like Shopify, for example, or Netflix or whatever. So I really felt like I'm really missing something here, just with a traditional kind of GARP approach. And so over time, I think I've evolved to more unorthodox situations where maybe what's happening beneath the surface is there's something really interesting happening, but it's happening beneath the surface, and it's not obvious from the sort of headline financials. So that requires digging deeper and thinking a lot further out, and maybe focusing more on what's happening in the terminal value, which might seem sort of controversial, or that would make a lot of people and a lot of investors uncomfortable. So that's kind of where I've graduated to over time, and I think it's made a real difference.
I love you talking about the unorthodox investment. So if somebody was trying to improve at that, what would be some things that you would suggest they do, or some ways that they change their thinking?
So practically, what is a game changer? So one thing that I've never recommended to anyone before, but I would say take the 5 stocks that you think in the market are just the craziest, the most overvalued stocks that make no sense, like Snowflake. So I haven't done work on Snowflake, but it's like 150 times revenue or whatever. Take Tesla, it's just 5 stocks, whatever, and buy 1 share of each, and say I'm going to hold them for 3 to 5 years, and then just revisit them in 3 to 5 years, and at least you'll learn something from that. Look, obviously what I would say is companies that you think have, the starting point is not just pure craziness, but it's companies with like a really good product or good management team, or the kind of stocks where you say, love the products, love the company, but it's too expensive. And whenever, like a simple kind of rule of thumb is whenever I found myself saying that, it's almost always being a buying opportunity. Like whenever you find yourself saying, love the company, but too expensive, I mean, you got to look twice. And I know people who were saying that with Snowflake. I was looking on Twitter, and people were like, great company, too expensive. And I was like, man, this is probably a buying signal. But I didn't buy it because, I don't know, reasons. But so I would just say, like, there's something about actually just taking the first step that's super powerful. Even for me, like a few years ago, just buying Netflix when people say, oh, crazy, makes no sense, or Amazon, it just that act of owning it is just like transformative, just transforms your thinking. Because like, I think there's a lot of kind of dogma in investing, and almost like moralism. And you feel like if you buy this expensive stock, like somewhere Ben Graham is weeping, or Warren Buffett is just disappointed with you, or he's going to be angry. So, but what you'll find is you'll buy these things, and they'll go up, and they'll go up, and they'll go up, and they'll go up, and you might learn something. Or if you'll come back in 3 to 5 years and they've gone down, and then you can say, well, I was right in the first place, and you can pat yourself on the back. But at a minimum, there's a good chance you'll learn something. But the starting point was, okay, so yeah, find crazy companies. But also, yeah, companies where you actually like the product. I think the product is key. Find something where there's something really interesting going on, and just buy the stock. That would be a starting point.
I love that. The ghosts of Ben Graham coming back to haunt you. I think that's so true. There is sort of this moralism, but I also love that idea where if you own something, you already have the endowment effect, affecting you. So you sent me over some principles, some materials already, and I want to talk about this concept of proxies versus principles that you talk about. So why don't you just give some more thoughts about that?
Yeah, so what I mean by that is I think we use proxies as kind of an oversimplification, or as a substitute for kind of truth in investing. And it can be like, so what is a good company? So it's like proxies are like return on invested capital, or margins, or cash flow, free cash flow conversion, stuff like that. Now, on the face of it, if you've got a high return on invested capital, or decent higher margins versus peers, or strong cash flow generation, typically that does show that it's a good company, but it doesn't really tell you the why. What you can also have is you can have a company that has high return on invested capital because they're murdering someone else in the value chain. So like either they're killing their suppliers or they are hurting they're squeezing their customers, and they're sort of over leveraging their power in the supply chain. Now, short term that can be good, but long term it can be really, really bad. And then the flip side is also you can have companies that don't have good margins or don't have good returns on invested capital or don't have good free cash flow generation, but they're really doing the right things and creating a lot of value for other players in the value chain, like their customers. And over time, and they're reinvesting in the product, or they're sort of reinvesting in marketing or R&D and all of that stuff, which over time will lead to them capturing some share of value, and the metrics are likely to be materially better in time. And so I think you've got to peel away a couple of the layers and see what is a good company. So in my view, it's more a company that creates a great product that adds value to consumers and adds more and more value over time to consumers and society. And so that requires a different type of work or different type of analysis, and you've got to go deeper, and then perhaps you've got to also think laterally. And I think this you can extend this sort of principles over proxies kind of idea to other areas, I think you can sort of memorize things in investing, like Porter's 5 forces or like names of mental models or whatever, but you don't always necessarily you can just kind of learn the label and the jargon and stuff without really understanding like what the essence of it is. And then sometimes those things can actually be counterproductive. Like I'm not even sure how good sort of Porter's 5 forces is in the current sort of landscape, because it means like the idea of leveraging your power over like different parties within the value chain, that sort of mindset, I'm not sure is kind of helpful anymore. And other ideas, like even these sort of oversimplifications, like you're back to the kind of the dogma and the sort of moralism kind of story, like this idea of Mr. Market, who's this irrational idiot, and he's always basically he's stupid, and he just leaves money on the table. And like maybe that was a useful construct, I don't know, at various points in time, but I just don't think it's a helpful way to think about the market on an ongoing basis. So, I mean, yeah, you can apply this in multiple different ways, but it's just, I think it's always about like really trying to go towards what is the truth, and like in some ways, investing is kind of is like a search for truth in a sense, and it's about peeling away the layers and all the superficialities and the kind of the broad simplifications that can actually be misleading in a way.
Yeah, that's really interesting. So I'd love you to talk a little bit more about assessing the value chain. So you mentioned that really the purpose of or like a good business is just how much value it creates for all the parties around it. So what is your actual process for ferreting that out and figuring that out?
So part of when I look at the company is, so I've got the whole research process and the research note, and there's a sort of broad simplification as well, like what's the thesis in kind of in 2 sentences, and what's the kind of the big idea, and then I've got a separate section where I go into a lot more depth where I say, like what is the product, what does it do, what's the jobs to be done that it solves for people. And then questions around like what's the total addressable market, what's the management team, and kind of all of that thing. But like where I think something that's where the portfolio is actually tilted towards more recently, and as a kind of coming out of COVID. And it's just this sort of big idea that's been growing on me, is like this idea of so I really like marketplaces, just because I think they create the potential for everyone, or the opportunity for everyone to win, not the guarantee. So just because you're a seller on Etsy, it doesn't guarantee that you're going to do well. You also need to have a great product, but they provide a platform for you to sell your stuff. And so, so roughly about half of the portfolio is enables small businesses, and I think that's going to be kind of a really powerful idea over the next however long. I think what's happening kind of globally, and what I think COVID is in this last sort of 9 months has sort of woken me up to, is this idea of you've got these global platforms providing enterprise level tools and distribution to individuals and small businesses, to have sort of unprecedented reach and unprecedented tools. And I think that wins for the platforms like Fiverr, which you covered last week and which is in the portfolio, and Etsy and Shopify, Amazon, these kind of companies. Now, yeah, as I say, is everyone guaranteed to win? No, but it can be. You can get a kickstart in your business. You can sell on Etsy. Over time, you can create your own shop on via Shopify. You can have you can sell via Pinterest or Instagram. They create these scenarios where I think, logically, most players in the value chain can win. And then the same is true, I think, in this these sort of developer first, like sort of for developers by developers kind of companies like Twilio. So I think there's lots of there's just lots and lots of more and more examples of that kind of thing going on. And I think you see in the language that the way that the company talks about the developers or their customers or the merchants, which I mean Shopify is a great example of that. They're very, very clearly, they're always sort of merchant first. Amazon is always like customer first, and you see that coming kind of through quite clearly. But it's really baked into the business model that's that sort of ecosystem where sort of multiple parties can win.
Yeah, I love that. So it might be fun to transition to some names, and then we can talk about your process more through that. So two companies in particular that I would love to talk about are Snapchat and Tesla. Just because a lot of people might think of those as, like the Robinhood stocks, or, the people won't really take those seriously, but I love that they're in your portfolio. So maybe let's start with Snapchat, and then we can move to Tesla. So how did you hear about it? What was kind of your process or your evolution of actually adding it to your portfolio?
So I don't know if you can tell, but it's Snapchat is really aimed at a slightly younger demographic than me. And so I think Snapchat Snap as a company had kind of dropped off my radar entirely. And then I came across an article, I think by Packy McCormick of the Not Boring blog. And so he sort of painted quite a vivid picture of the company. And then I think Turner Novak on Twitter has mentioned it a few times. So, but I think Packy's sort of his note really kind of opened my eyes again, and I thought, okay, this is what's happening here is quite interesting. And it was also interesting because I thought, dudes my age and like guys like me kind of dominates the finance landscape, and so guys like me are probably going to be very late to the game in something like this. So that I think that creates almost a structural opportunity. So I looked at Snapchat, and the headline metrics are a mess. Like the cash flows aren't great, the margins aren't great. But I think what was happening is that like things are moving in the right direction. So they're growing their users around the world at a fairly rapid clip. And they've got sort of roughly 90 million users in North America, which is really, it's high relative to Instagram and other social networks. So I thought, and this is a very young kind of engaged audience. So look, the metrics are heading in the right direction in terms of revenue, ARPU, monthly active users. Now, what I also did was I downloaded the app and I played around with it with my kids. So my kids are also slightly too young. They're sort of 7, 9, and 11, but we messed around with it, and it's quite sort of silly, and it's quite fun playing with the lenses. And so it's quite engaging and interactive, whereas, you know, a platform like Facebook is a lot more passive. You just kind of, or Twitter's got passive, and you just kind of consume. So there was something kind of fun and different about it that I really liked. So in my mind, I thought, okay, there's a kind of a central scenario where, and well, some other background is I think for the longest time, Facebook has just murdered the competition, both sort of you know, business-wise and as a stock. And so Twitter has just been a non-event for you know, 5+ years, and Facebook has just kind of won and won and won and won. And I think I'd almost kind of I'd almost taken it as a given that would just continue. But I think what you've seen since it's sort of over the course of the pandemic is both Snapchat and Pinterest have really shown an improvement in their ARPUs and are still growing rapidly. And I think what's happening is that it comes down to this idea that Evan Spiegel has spoken about, is transitioning from a product to a business, which is not easy. And I think, you know, Snapchat and Evan Spiegel had made a number of mistakes over the years, and how can you blame him? He's young, it's his, you know, first business. And so people had, I guess, had kind of written them off. But in that sort of, they made mistakes with the product and the business, but over time they've sort of corrected their mistakes, they've learned from them, and they've improved both the product that users see, and then also the kind of the ad tech stack kind of behind the scenes. And I think Pinterest has done the same thing. So they still I think quite a long way behind Facebook in terms of the solutions that they provide, but in terms of the sort of cost per impression, there's still a huge gap there, which I think can close, you know, not fully, but that can certainly be improved over time. So your central case is, okay, they've got roughly 250 million users around the world. Probably that grows because they've been doing a really good job, and they're improving their products internationally. Like, they and Pinterest have been miles behind Facebook in investing in global markets, and they're only doing some of the basic stuff today, and they only fixed their Android platform, which is big in the rest of the world, like over the past few years. Like, it's really, really basic stuff that they're only starting to get right lately. So I think there's a natural tailwind there, and so your base case is actually they improve ARPU, and they carry on growing monthly active users, and actually as they improve, this will become a better business over time. Your return should be, yeah, pretty good, but not necessarily spectacular. I think where it gets really quite interesting is if you look at what they're doing with augmented reality and the lenses. And again, they've created this platform through Lens Studio where either users or third-party developers can build their own lenses. And so it starts as like, and this is, I don't know where the saying came from, but it starts as almost like a toy, and then people just build, and they provide the Lego blocks to people, and then it becomes something more kind of interesting and sort of, the use cases should proliferate over time, and they're just sort of starting to scratch the surface of what's possible in e-commerce. So you hold up your phone and you can see what a pair of the new Nikes look like on your feet, or I know, like Etsy, for example, you hold up your phone and you can see like a picture, what it would look like up on your wall. And so who knows where this could go? And then they kind of, so there's that element, which I think is super, super interesting. And I mean, who knows what the use cases could be. And then you've got the other stuff like the Bitmoji and the avatars. And so you're starting to get into this kind of, I don't want to use the word metaverse, but sort of digital space and what you can do with that. And they're sort of allowing those kind of the AR and the Bitmojis to port not just across into other platforms. How they monetize that and what they do with that in the end, I'm not sure, but we'll have to see. And then they're doing other stuff. They've got the media content on there. They've got maps. And then they're starting to integrate games and sort of in-app games. And then the final thing is the kind of the sort of mini apps. So they've got like the Headspace app, which you access in Snap itself. And what was interesting to me is I looked at all of this and said, this reminds me a lot of the Tencent strategy. So Tencent is an investor in Snap. Whether they've had an influence in this strategy, I'm not sure, but it's really quite reminiscent of Tencent's strategy with WeChat. So if they are able to, so you've got this sort of base case idea of where they get to, quite interesting. Stock probably does quite well. With one scenario, and it's difficult to know what sort of probability to attach that, but one scenario, if they're able to execute on this whole super app idea, then I think there's going to be monstrous upside in the stock, because the ARPU is just going to go up. Like it just goes from being a sort of a fun kind of camera app to who knows what the use cases could be. I think they're still missing a kind of a really good kind of integrated payments piece, and I think that could be the kind of the key to unlocking a lot of this. But we'll see. And so, I mean, the way I construct the portfolio is I'm fairly, I reach a certain level of conviction, but what I typically do is go in kind of roughly equal weight. And so like if it's going to be in the portfolio, it goes in roughly equal weight, and then each stock has got to prove itself, and the winners will the cream will rise to the top, and then the others won't. Because I think an issue that I had was you can tend to sort of underweight the highest potential stocks because they seem the riskiest, and you just miss that one, and it can make all the difference to your portfolio. Because I'm really looking for multi-baggers. I'm looking for stocks that can increase sort of multiples of their current size. So that's what I did with Snapchat. Sort of gradually got it up to that level, roughly equal weight. And I was kind of, I've got a base level of conviction, but I'm somewhat agnostic. I'll say, let's see how this plays out. Let's give it time. Let's give it rope. And if they don't execute, well, then I can always change my mind. But I certainly don't go in there saying, I'm certain of anything. I'm somewhat agnostic. Like let's see. I like it. Let's see how this plays out. And so that was my thinking with Snapchat. And so far I've been really positively surprised. And then the one thing that I noticed that's really come out strongly, which I'd never really picked up before, was the power of the direct response model and direct response advertising, which you saw the power of that during the pandemic. I mean, for Snapchat, and then for Facebook too, which is just a really. So a lot of these platforms that I spoke about, the sort of the marketplaces where you've got this kind of where the whole ecosystem can win. There's like an inbuilt flexibility and responsiveness. So like in Etsy, for example, they said, guys, there's a lot of demand for masks, like make masks, so they made masks. And the same is true for this direct response ads. Like as demand from sort of large brand advertisers comes down, then it sort of lowers the cost per impression, and then sort of apps or games or whatever can kind of come in and bid for that. So like that's another thing I like, where there's just an inbuilt flexibility and responsiveness within the platform. And so Snap has got that. So I think it's interesting. It's done well, but I think there could still be quite a long way to go.
Thanks for breaking that down. So one thing that I notice about you is just your ability to really stay open-minded about things, and talking about that moralism, or if I add Snap to the portfolio, I'm not afraid of changing my mind. So are there any practical tips that you would give to people that are maybe trying to improve their open-mindedness, or do you think that is something that is just like almost genetic?
That's a good question. I think I was less open-minded before, and then if you are, I think it also depends on what you want out of the market. So I think there's in one of the Market Wizards books, I think it's William Eckhart says, like, everyone gets what they want out of the market, which is quite a profound statement if you sort of unpack it. So you've got to decide, do I want to be, is my reason for being in the market to be an XYZ investor? Am I here to be a value investor? Am I here to be a growth investor? Am I here to be a mini Warren Buffett or the next blah blah? Or you say, is my goal to generate returns? And those two are not the same kind of, they're not the same. So if you frame it as your goal is, look, my goal is to make returns, then you've got to work backwards from that and say, okay, what do I need to do to make returns? And so I found over time that a lot of those traditional frameworks and ways of looking at the world and ways of looking at the market didn't provide the kind of returns that I wanted. And so I was like, I believe X, but this stock, which doesn't meet X criteria, is going up a lot, and the stock that does meet X criteria is going down a lot. I want to own that one, not that one. And so, look, that's been the case. That's been the case for me, and it hasn't necessarily been. I can't say that is true for everyone else, but if it is true for me, it's probably true for other people too. Another thing I'll say is, so the first thing is to just be aware of it, and just be aware of the role that your sort of existing beliefs, your investing beliefs play, because we all think that we're objective and we view the world objectively, but frankly, we all look through these glasses, and you almost see what you are taught to see, or in a way that kind of meets your beliefs. That's how you filter it. So if you're like a sort of a deep value guy, you look at Snowflake and you say, well, obviously everyone is just stupid and just high on fed juice and like blah blah blah. So which well, look, it might be true. I mean, it could. Yeah, I mean, it could. So, but maybe there's another truth. And the guys who own Snowflake, I mean, they're not stupid. They know that it's on 150 times sales, and they're buying the stock. And so, the first part is just being aware. And I think, but if you start with the idea of like, what do I want out of the market? I want stocks to go up, basically, and the more they go up, the better. And then you find stocks that meet that criteria, and you open your eyes to what's actually happening, not what should be happening, or what has XYZ school kind of taught me. So I found that helpful, and I think one key is just to experiment. It's just experiment. You don't have to do it in a big way. But I think experimentation and making mistakes is very important. That's how we move forward. I think, you don't want to be sort of too risk averse, too cautious, too dogmatic. And the other thing is, I think you want to approach the world in an optimistic as an optimist. The more optimistic you are, the more you just open your eyes to a world of opportunities out there. And I think you want to be a bull, like you want to be a believer, and the maths just works out too. It's, if you're wrong on a stock, okay, you lose. Look, worst case is you lose 100, but it's unlikely that you're going to lose 100%. Like, by the time the stock's down 50, you've probably worked out that you made a mistake. But if you find like a great stock, I mean, it can go up 1,000%, it can go up 20,000, 10,000%, 20,000%. Like, your ratio is can be 10 to 1, 100 to 1. So, you really want to focus more on really capturing that right tail. Like, think big, don't think too small. I don't know. Those are a couple of thoughts that I think have helped me over time.
Yeah, dropping a lot of wisdom on us. So thanks.
Only
We
because
talked
I've
about
made a lot of
Snap.
mistakes, Ryan.
We talked about Snap. Let's talk about Tesla. And I mean, this is probably the most controversial stock. I mean, it is almost like you said, gets back to like a moral thing. If you ever put something out on Twitter about Tesla, you can be sure that you're going to get a lot of comments with very strong views. So, I mean, I would love to hear your journey about owning Tesla.
Okay, so yeah, please don't hate on me, everyone. Either way, I think I'm going to upset a lot of people. So anyway, so actually Tesla's is as being just I made a huge mistake with Tesla, like just monstrous. Like, so I was looking at it maybe first, second quarter last year, and I thought this is really interesting. I did quite a lot of work in it, and I thought there was really, really interesting asymmetry there, like I've described. So I thought, maybe the stock goes down 50%. It's not going to go to zero. Like, I didn't agree with those people. I think if it goes down 50%, then probably Google or Apple steps in and buys them up. That's what I thought. But if it works out, I mean, this could go up 10x or something like that. And so I saw that sort of asymmetry there. But I messed up because I thought, well, like, this is the problem. I went down that whole Tesla Q sort of rabbit hole on on FinTwit and stuff about, oh no, Elon is this, that, and the next thing, and the bad build quality and all this kind of stuff. And I was like, well, I'm not sure that I have an edge here. And at the same time, he was doing all that all that sort of controversial stuff, and I just thought, just avoid it. And that was really a mistake, because I think the amount of asymmetry really trumps edge, like, totally. Like, there's an interesting paper by a guy called Richard Zeckhauser, I think, called "Investing in the Unknown and Unknowable," and he really talks about going into these kind of murky kind of situations, essentially where others fear to tread and where people fear to tread, and it's really hard to assess the probabilities and the odds and the payoff. But if you can see something with a massive asymmetry, like, you've just got to go for it, and you can't be afraid of looking stupid. And one of his points was, if you don't look stupid from time to time, then you're just not pushing the envelope enough. And so anyway, I didn't push the envelope, and the stock went up boatloads. But then, and then I thought earlier, so I revisited the stock, actually not all that long ago, a couple of months ago, and I thought, it was one of those situations where I thought, like, have I really missed this? Like, maybe I just thought, just thinking like long term, maybe Tesla could still be like, Tesla could be to the 2020s what Apple and the FANG stocks were to the 2010s. Like, I can see that scenario where, it's still early days in terms of the EV market, in terms of what they want to do with solar, in terms of the battery technology, never mind autonomous and the autonomous fleet and robo-taxis and all of those kind of things. And I thought, I think they've still just got, as I watched Battery Day and other stuff, I revisited my notes. I was like, I think their competitive advantage relative to peers is just growing and growing and growing. And I think because they're vertically integrated, like, they're just solving a number of enormously challenging problems. And if you're sort of a legacy incumbent, essentially what you've done is you farmed out your whole supply chain. And what the sort of legacy automakers are, they're largely assembly companies. So you've got hundreds of suppliers, and then you're just assembly. Whereas Tesla can solve part by part, piece by piece, like machine by machine, thousands and millions of small problems. And this is a cumulative sort of knowledge curve and learning curve, which is like a decade-long advantage for them. So how do the incumbents overcome that? I just don't know, particularly when they're not vertically integrated. But I think the other kind of rule of thumb I have, or sort of point to kind of trigger myself, is saying, if I already held this stock and I was up, 1,000,000%, and it was X% of my portfolio, what would I be doing now? Would I be selling? And I thought, there is no way I would be selling now. Like, the financials are just really starting to come through nicely. Like, you've got China ramping up, you've got sort of Giga Berlin. They're just going to be adding more and more plants, factories over time. I mean, I still think it's early days. But then perhaps perhaps the insight, or maybe unconventional way of looking at it, and this is very, very non-purist, but I looked at the supply-demand dynamic for the shares as opposed to for the company. And I thought, think about the supply of Tesla shares. People who hold Tesla, by and large, are proper believers. Like, they are, I think they are very, very price insensitive. Like, if you think of, obviously, Kathy Wood and Bailey Gifford and those guys, I mean, they are not sellers of the stock. They really, really buy into this kind of 10-year, 20-year vision. So they're not sellers. And this was before the sort of S&P inclusion. And the guys who are bearish, they kind of don't matter because they don't hold the stock anyway. Like, they've sold, or they're not in there. And then I thought, how many large cap sort of mutual fund managers own Tesla? I don't know, maybe the number's 10%, 20%. And how many of those hold it in their top 10? Probably not many. But with S&P inclusion, that number's got to go up. You don't want to be underweight a stock that's sort of doubling every year or goes up 500%. And then you look at, like, a name that's sort of very comfortable to own. You'd be proud to present it to your investors. You say, like a Visa or a MasterCard or Microsoft. What a wonderful company, great business, great margins, great returns on capital. I'm a safe pair of hands, wonderful, and I like those companies. But there's like probably 60 to 90% of managers hold that. You look at a sort of top 10s that's there, that all of those names are there. So Tesla's just got to go from, like, I don't know, mid-teens sort of representation to sort of 25, 35, 45 at a time. That's a lot of incremental demand for those shares. And the other thing you think about is, so your S&P inclusion, so you've got all the passive funds, but then you've got funds that are benchmarked against that. That is a real source of demand. And then the other thing I thought of is, like, ESG and sustainability is just becoming a bigger and bigger phenomenon, and more managers are going to be assessed against that. And so I think Tesla could really be the poster child for the sustainability sort of clean energy movement. And so if you're an ESG, or if you're a sustainability fund, like, there's every reason that's going to be a massive holding for you, because it's a large cap. Like, a lot of these other things are really small and illiquid, and it's just difficult to buy them. So as money pours into that theme, I think there's a lot of incremental demand for Tesla. And then you mentioned sort of Robinhood traders. And so I've also got this thesis where I think there could be a lot of money to be made by following young retail investors over time. And so the way these guys invest is they invest in brands and companies that they really relate to, and that they love, and that they back. And they're not all doing sort of discounted cash flow analysis. They've got sort of, I guess, like sort of non-purely financial reasons for owning these companies. And I think these investors, like, so obviously passive is growing, but I think retail investors could come back into this market, just sort of enabled by Cash App and Robinhood. And they've made a lot of money early on in this sort of current bull market this year. And so that's going to give them confidence. And I think they could actually be, like, sort of contrary to conventional wisdom, I think they could be a source of kind of smart money. So they will buy, they're not going to own 50 stocks. They'll own a handful, and they'll form these communities, like the whole Tesla community. They will probably end up knowing those companies better than the sell side or the buy side. They're just a narrow focus, and they'll buy those stocks, and eventually, and I think they'll be ahead of the institutions, because the institutions are inherently conservative and they want proof before they do anything. but that's like another source of essentially price insensitive buying. And the thing with Tesla also is, if the majority of the shareholder base is buying into like a kind of a 10-year vision, that vision and that terminal value is kind of neither provable or disprovable for almost 10 years. So you might not agree with it, but like you won't get clear evidence for a long time that you're unequivocally wrong about your bull thesis. But what is happening is they are selling more and more cars, and they are making progress, and they are making better cars over time. So I would say incrementally you are getting more and more kind of evidence to support that thesis. So I know a lot of guys won't want to hear that, and they'll sort of see that as a sign of me drinking the Kool-Aid. Maybe it is. Tesla's not my child. But I do hope, I really hope they succeed, because a world in which Tesla does really well and sells 20 million cars or 50 million cars is, I think it's good for everyone. I mean, how can you not want them to succeed? So, will I be a shareholder the whole time? Who knows? But I think I just see a lot of factors kind of lining up for the company and for the stock, and ultimately I hold the stock, and you can have, and I think that's something else. Like, you can just say, yes, we hold companies, not stocks. I get that, but I mean, and you might rejoice and be buying all the way down as your stock goes down 99%, but that's not me. So I want to get the company right and the stock right if I can. So that's a sort of a highly simplified view of Tesla, but we'll see.
Yeah, thanks for going through that. That's an amazing quote. Tesla's not my child. I think that really gets to the core of it. And I like how you differentiate between the company and the stock, actually looking at the supply and demand for the stock, and sort of zooming out and also being able to zoom in. So, I mean, I'm really enjoying this. This hour has flown by. So do you mind doing one more stock and just kind of laying out the thesis? I've been loving it so far.
Okay. Let me just let's have a look at the portfolio. So look, why not? I'm still looking at going through the S1, which one I think I'd like to own. So we don't have to talk about this, but it's Roblox. I think that's a super, super interesting idea because my kids play it. There's a few things on the take rate that I'm not so sure about. But okay, yeah. So another stock that's just been such a great winner, and I still continue to believe in is C, in Southeast Asia. So I think you hold it too, or you've recommended it as the Southeast Asian gaming and e-commerce company. And so again, so I got this idea, I think Hayden Capital put up a really good research piece like 18 months ago, and so I read that and I thought it was really quite interesting. And look, see, at the time, I think, I can't remember when I bought it, but in like the low 20s, like a sort of maybe it was first or early second quarter last year. And I thought it was maybe at like a $10 billion EV or market cap or something. So I thought maybe this company could become a sort of $100 billion company in 10 years. I think that potential is there. And you see, fast forward 18 months, we're almost there. So it's just, I mean, it just shows you kind of what's possible. And I think it's more possible today than ever before, just given the sort of digital and global sort of nature of investing. And I think why it's such an exciting time to be an investor. I think these things can scale at a faster pace than you could ever have imagined. So yeah, so what C had at the time was, what I recognized was they had this mobile game called Free Fire, which was doing phenomenally well, and they were using that to reinvest in the e-commerce platform called Shopee. And obviously both have been huge beneficiaries of the pandemic. What I would say is, and the bulk of my sort of valuation of where I thought the value would lie was in the e-commerce side. Like, because also what I've noticed was in the sort of leading e-commerce player in each kind of market becomes like the biggest or second biggest company in that market. You saw it with Amazon and you saw it with Alibaba. And then sort of I applied the same logic to Mercado Libre, because I also own Mercado Libre in the fund. And so I thought there's every reason to believe that this could happen with C. So I've been a believer in the e-commerce side, and yes, it's loss making, but every metric, every quarter is just trending in the right direction in terms of like the loss per orders just kept on coming down. Just the growth in GMV, the growth in revenue, that's all happening. I've totally underestimated their execution on Free Fire and the game. Like they have done an unbelievable job, and so that whole game is, that's at like a sort of $500 billion of EBITDA, I think, last quarter. So it's like a $2 billion EBITDA run rate. I mean, that is phenomenal. And they've just done an amazing job of just localizing that game in each market and just innovating. And so, I mean, the stock has really done well, but there are scenarios where, as they layer on, as they sort of build out now the financial services on, and it's early days in that too. It's another one where you look at it and say, okay, well, initially I thought it could get to $100 billion and we're a stone throw from there today, but who's to say this might become a $500 billion company in time, or $1 trillion? And like $1 trillion is the old $100 billion. It's just, these numbers are just a different meaning these days. So I think there's a lot to be said for just sticking with these names as long as the company executes, and not sort of being too fixed on like a target price or an exit point. But there's so many of these opportunities out there. So I just think it's just a really, really exciting time to be an investor.
Totally. So I'm sure a question that a lot of people kind of in the back of their minds as they're listening to this, like, what about valuation? So what are sort of just even practically and philosophically, how do you think about these? Are you looking out and creating an earnings model, or are you just kind of buying and holding as the thesis plays out? Just some few thoughts on that would be awesome.
So look, the starting thought would be that valuation, or an obsession and focus on valuation, has been unbelievably expensive in my career. It has cost me so much in terms of returns. Like it's just staggering. Like how much money is being left on the table and the opportunity cost. So that would be the starting point. So I build models. Like I've got a model for C. Like I've got a super detailed model on like Roku and Mercado Libre. I think the real value in that is not so much what the model says, but it's more the process of going through the line items and just understanding like how different things move together, and I guess just thinking about how the stuff kind of pulls through. But I think valuation has become less and less an important part of my whole process. And so, yeah, maybe today's the peak. Maybe I've got my comeuppance coming, and I'm going to be punished for my recklessness. But I just think the great companies. Look, I think if you're going to hold like a Unilever or a Nestle or a JP Morgan, I think so. One analogy I thought of for Tesla and maybe Snowflake and some of these other things is like they're like rockets, and once a rocket leaves the Earth's sort of gravitational pull and it's out in sort of deep space, gravity actually doesn't matter anymore. And so I think of gravity like valuations. And again, please don't hate on me on Twitter and stuff. Like these are my view. Like don't take it personally, but if you're JP Morgan or Nestle or Unilever, like there's there's sort of some limit to what people will pay. Although even like when interest rates are now zero, like for a high quality company like Nestle or Unilever, I don't know. I think valuation could get really, really crazy. But like put that aside. But once you've kind of broken away from gravity, like it's just not a pull anymore. So like, that seems to be the case with Snowflake. So these companies kind of break the rules. And the problem with a lot of these things is when the valuation starts making sense again in terms of free cash flow, PE, or whatever, to a large extent, the story's over. Like a lot of the returns are sort of tend to be like really front end loaded. And by the time things sort of really make sense from a conventional perspective, the story's kind of done, like from a stock perspective. So I never want to say like valuation doesn't matter, but just for me personally. So, everyone else, you can ignore this, but just for me, I think sort of lessening the importance of valuation has helped me. I don't know. We shall see.
Right. No, it's super interesting, and don't want to take up too much more of your time. I've been really enjoying this, but a closing question is, are there any daily habits that have really contributed to where you're at right now?
Coffee and wine, right? So start my day with a cup of coffee with my wife, close my day with a glass of wine with my wife. So I think it's important to get away from the screen and sort of not attach your entire persona and self-worth with your portfolio, which has been something that's been very helpful to me over time. But from a like maybe purely investing perspective, like I keep a journal, so I write down just thoughts on the portfolio, on the markets, on my own psychology, on my emotions, things I'm seeing, things I'm learning, mistakes I've made. And so that has been super, super helpful in my evolution as an investor. And it's also, I think, it can be quite sort of therapeutic at times. And I just find that the exercise of writing, like a good way of thinking. So I sort of think through writing too, so I find that really helpful and would recommend it to everyone.
Yeah, that's awesome. I keep an investing journal as well. And a small heuristic for myself is when the market is falling and I'm starting to get nervous, I find myself starting to write in capital letters. And when I start writing in caps, then it's time to buy.
Yeah, okay, interesting. Maybe I should do that too. Yeah. So in the same situation, I'm curled into a ball under my desk, sucking my thumb. So not really. I'm joking. That's not true.
Well, thanks so much for coming on, Nick. Like I said multiple times, I've really enjoyed this, so appreciate your time.
Thanks, Ryan, and I hope I haven't offended too many people.
No, I think it's good. Okay, have a good one.
Cool, thank you.